How's it going, everybody? Chad Shoup here, and today we're walking through one of my favorite stock trading strategies, option trading strategies, whatever you want to call it. It's a great way to spot stocks that are going to be headed higher or lower in the months ahead. So it's going to take about 2 months for these trades to play out. On the max side of things, typically you're looking at about 30 to 45 days that you want to jump in and get out. And this is part of a series that I've been doing recently to just kind of walk back through some of my top trading strategies that I use in my own accounts that I've created over the last decade in the stock market. And I'm doing this also because, look, I have a service right now that's basically taking the best trade every single week, just one trade, and we're jumping into a trade out of these strategies or out of something else that I see in the market every single week. And I just wanted to give more details on how those strategies work so everybody can be on the same page. And when I say that, like today, we're jumping into an earnings drift trade, you can automatically, you'll know what that means because you know the research that I put into it to analyze these types of trades, and right away it'll click, and then you know exactly what to expect and what's kind of behind the idea of the trade analysis that I have for that one coming up. And the service is called Bank It or Tank It Elite. So up here in the corner, I'll have a link that you can click to learn more about the service, to click on to subscribe. It's one low price for an entire year, and it's one of my best trades every single week from these proven strategies that I have over the years. And by taking one trade a week, it is hit or miss, but we've seen some big winners already, some big triple-digit gains in a very short amount of time, and we even have trades that are set up to get big gains in just a couple of days. And then we have income opportunities that I'm going to be looking into here during this year that will be able to fit in there as well. So look, today we're talking about the earnings drift strategy in my Bank It or Tank It Elite service. So I don't have a separate service all around this earnings drift approach, but it is something that I've been studying since going back to 2015. I've been beta testing this idea, this concept. There's a ton of research out there about this idea, and it's called a post-earnings announcement drift. And what these scholars and research studies have proven is that after a company announces strong results that kind of blow past expectations, their earnings are up, their revenues are up, so you're seeing a big earnings beat, you're seeing a big move in the market. And what happens is that it's not all priced in right away. I mean, earnings are like a whirlwind of news hitting the stock all at one time. And there's a theory that everything's priced into the market always. As soon as earnings come out, it's fully priced in. That's what's supposed to happen. If the market's so efficient that you can't make money on and trading strategies and that sort of thing, as soon as earnings come out, it's supposed to be fully priced in, and technically the price should basically stay flat until some more stuff is going to happen and actually make the stock move. Some more events, whether it's a Federal Reserve event, whether it's another earnings event, but that's that idea of an efficient market hypothesis, that's really supposed to be what's driving the market, not supply, demand, not expectations, not investors just bidding up a stock or pulling it down. They ignore all that, but that's what takes place. There's a fundamental relationship between the human analysis on these companies and how they're going to perform after that. So think of earnings. It's bam, they hit their market with their earnings. They dump all this data, whether they're beating earnings, missing expectations. They have a conference call with investors, and investors are just trying to peel into this and figure out really what's going on. So right away they do try to make an adjustment. They're upping their earnings expectations for the next quarter. They're lowering them. They're changing them. They're making buy ratings, sell ratings. They're taking action. They're telling the bigger Wall Street banks what to expect from this stock going ahead. And right away we see the stocks jump. The big move on the day of earnings. You see the stock shoot up or higher. It could jump 5, 10, 20%, even more, or fall the same amount. And people love to gamble on the event. And it's fun. It's fun to gamble on the event. And when you're right, it can land you some big profits. So that's for another day, if you want to do that. The other thing that happens is that going into the event, so the couple of weeks before the event happens, the earnings announcement, options premiums are going to spike. So if you're trying to trade it with options, it's tough to get in like the week before because they're already pricing in a 5 to 10% move in most of these stocks. And if that's the case, you need a bigger move to even make money. So if it's pricing in a 10% move in the call option that you buy, that means you need a 15%, a 20% jump to really hit a triple-digit gain. But you need a bigger move than 10%. If the stock jumps 5%, you're still losing money. You're out of a lot of money at that point. And that's basically right on the next day that option premium gets sucked away again. So the way I like to trade earnings, and what I've been doing since 2015, is trading after the event. After they announce earnings, we look for this drift. And honestly, from 2016, I'm going to show you one of those trades, the best one actually, just to highlight it, and then we'll get into some more recent stuff. And I'll show you how I've transformed this strategy and this concept over the last 12 months. because from basically 2016 up to 2021, I had beta test data going back to 2006, so I already had the previous 10 years of data, looking at these companies, how they would announce earnings, and then how the stocks over the next 30 to 60 days would typically perform. And I was able to use that and run a service around this concept and do really well in 2016, 2017, 2018. We had our ups and downs for sure, and then we would go on a big run, big win streaks after that to quickly make up for it. So overall, it was a very solid service. Even going into 2020, we had the crash. I took some discretionary trades to offset it. Then we rebounded from that, and then things took off right there when the market rebounded sharply in 2020. Then in 2021, though, the mean reversion trades really kicked in. So the thing about a stock on earnings, how they announce and then they jump higher. So the 5-10% move higher. And what we're looking for is that strong momentum to count as a breakout. That's what we saw, throughout those years that I covered that I was trading it. That's typically what would happen. The stock would jump and we'd get the breakout that we were expecting, and then it would continue higher from there, and we could make profits about 70% of the time on these trades. That's a big win rate, especially when you're trading options, and especially when the winners can go on up to 200-300% or more in quick fashion. So that was a very lucrative strategy up until 2021. Then that all changed. Those stocks that would go up 5 or 10%, they would signal a buy signal, they would look like a breakout, everything would be lining up, we would jump in and expect it to continue in that direction, whether it's call options to the upside or put options to the downside. And honestly, we were getting our butts kicked for about a year. And it took that long for it to really just kind of start to shift gears. And then in 2022, it was another rough year. That was the bear market. So 2021, it was later in that year and then carried into 2022. And then later in 2022, it started to come back a little bit. Now in 2023, I think that we're going to see these trades really start to rebound as the market starts to settle. So I do want to start implementing some of that old strategies that I've been using, which was focusing on a stock and how it particularly performed, going back and looking at the prior analysis. So the first stock we're going to look at today is Caterpillar. So you can see on the chart here, definitely a big move to the upside. But what we have is these big gaps higher, some consolidation, and then it moves up. Another big gap higher, and then it continued to move up from there. And the one that we traded that landed us over a 500% return on the second half of the trade in the options market. So it was a massive move, and we held a little longer than usual. I'll admit that. But look, it was this one in October, a big jump higher on earnings. That was a nice move for the stock. And then it consolidated a little bit. So we held to this because it didn't fall back down. It didn't close the gap. It came back down to about halfway of the gap, and then it started to bounce higher out of that and make a nice run over the next 2 to 3 months in this one. So it was a longer trade. But you can see that thing really ripped to the upside. It was a big move higher. It was just a continuation breakout, that runaway gap basically, as this thing just kept stair-stepping higher and moving to the upside. So that was great to see, and we were able to land a big game in Caterpillar. Now I'm showing you Caterpillar because it had a phenomenal history of once the stock has a big jump on earnings, had a big beat on expectations. Those were the two baselines that I was looking at. Over 5% move on the earnings announcement in the stock price, and over 5% move in the earnings expectations from what they were expected to report. So we can go further today. Now this is kind of what I'm changing in my analysis. This was a recent one. So this one was coming down here to the downside, choppy. Then it had the big break on earnings, and look at that, just continued higher, had the continuation pattern move out of this. But what I've been adding more recently, as I look into these earnings trades, is not so much about how they performed in the past, because 2022 really blew that up. The trades were just simply not working out, and that's exactly what I was going by. The same strategy that worked great that we started in 2015. It was beta tested all the way back to 2006 on a back test. Then beta tested in 2015 through 2016, about a year and a half. We rolled out live to traders, and it was still working out great. I mean, ups and downs. There's always going to be losses. I'm not saying it was every single trade was a winner. But overall, we were winning about 70% of the time from, that's a 6 or 7 year period almost that we were solidly running this service before it really took a dive. So that was concerning. And now the way that we're transitioning out of that and to kind of smooth out this process, because I still want to get back to those types of trades and start to build a real system around this concept once again. But right now I'm focused on breakouts and more technical analysis that kind of goes into the trade to support it. So we can see here with Caterpillar that we had a previous peak basically at the same price level that we came back up and had earnings at. So we had a breakout out of that. That was a breakout out of this consolidation in this pattern right here. And we also, on the relative rotation graph, we had just dipped into the weakening quadrant. So we went from leading to weakening, and then when we jumped higher, that threw it right back into the leading quadrant. So that was a big kind of whipsaw for the stock, right back up to leading the market, and we would expect that momentum to continue at least for the next few days, maybe a week or two. And that's exactly what we saw over the next 2 weeks before it consolidated and then continued higher from there. So overall, the idea worked here. The post-earnings announcement drift. We see a stock jump higher, consolidate, and then continue to move from there. So Caterpillar has been one going back for years that has worked out. Now, next one I want to look at was Netflix. So this company is to the downside this time. This was back in 2019 that that's one of the highlights because it's a good technical trend break on the stock. So right here we have this big consolidation area to where we're just kind of grinding it out to the sideways, and then earnings caused a big breakout on that. It was a massive drop here on earnings, and we see some volatility right around the day. The week following it, it wasn't a straight continuation pattern like we saw with Caterpillar. There was a little volatility, a retest of this gap area, but then it quickly reversed and continued lower from there to see a sharp drop in the stock over the next 2-month period. So again, this is to the downside. It works to the upside, to the downside. And you want to stay away from ones that are going to close this gap, because that's a long run that if you're trading the options, it's going to end up crushing your returns. If you're trading the stock, then you can hold on to some of this, even if it starts to retrace a little bit before it actually continues lower, because more times than not, that's going to be the case. And this research also goes back to just the simple concept of what happens after a stock jumps 5%. And on 60% of the time, no matter what the reasoning was, the stocks tend to continue higher. So when you narrow that down to earnings, and then when you actually focus on a price chart and narrow it down to the technical analysis, we can easily top 70% win rates here with this strategy, just implementing everything that we understand about the stock market and how things react. Now, I had one more that I was going to walk you through today with Cisco, and this was another trend break. So this one was pulling back here in 2020, and it had this clear resistance level that's exactly where the stock gapped up to on the day of earnings. So that's where it opened on earnings, continued higher from there, was choppy over the next couple of days, but overall we see this just nice little trend climb to the upside, nice steady uptrend that proves that it was just slowly climbing higher. So I tell you all this because this is kind of where the growth that we've seen in my earnings drift strategy. I mean, I know there's a lot to this concept that stocks tend to continue in the same direction after a big earnings beat and after a big move in the stock market. A lot of people look at this initial day in the stock for Cisco here where it's just, it surges to the upside, over 10% move. And if you didn't bet on the earnings, then a lot of people are like, the move's over. We'll wait for the next earnings announcement before we play it. But, a lot of times this is the more powerful period is in between earnings, this 1 to 2 month period that sees the stocks continue to make a solid climb. Think about it. After earnings, the options premiums kind of get sucked away. You're going to get a better deal in the options market. Still some volatility, but not nearly as much as there was before the stock jumped higher the day before. So at this point, the options volatility is settling down. You can come in, buy the options, and continue to look for the stock to head in the same direction. So that's how I trade earnings season right now with options in the market. There's a lot of ways that you can take advantage of the volatility, such as selling spreads, like an iron condor, or you can gamble on the event, which is fun, but you can't really do it and expect to come out ahead. It's just an easy trip to kind of, easy way to kind of avoid making a trip to the casino. Instead, you can gamble on an earnings event, bet a small amount and see if it turns into something big overnight. It's a fun, exhilarating time, but that's not what we invest for. We want to have higher win rates with big returns to continue to grow our money in the stock market. And that's why I focus on the earnings drift as I try to trade through the earnings season. And right now we're in the thick of the earnings season. So if you want more trades, more earnings drift trades, be sure to click the link either up here in the corner or down below in the comments, and make sure you like and subscribe to this channel because there's going to be a ton of more great content coming out. And I got another Bank It or Tank It YouTube video coming out later this week analyzing a couple of stocks to add them to my list for flash alerts. So I hope this video helped explain my earnings strategy a little bit and helps you understand how this Bank It or Tank It elite service is going to work down the road. So hopefully you'll join me in there, and that way you can get my top trade every single week. So until next time, I'm Chad Shoup.